These are 10 smart strategies for managing your 401k distributions. Hey everybody, my name is Cade Bekanich, managing partner of Park Lane Financial Group, and today we're diving into a topic that might not sound exciting at first, but trust me, mastering these strategies could potentially save you thousands of dollars in taxes and help you manage your retirement savings to last longer. We're talking about smart ways to manage your 401k distributions. Whether retirement is decades away or just around the corner, understanding how to efficiently withdraw from your 401k can make a dramatic difference in your overall financial security. Many people spend decades diligently contributing to their retirement accounts, but then give very little thought to the withdrawal strategy. And that's where the costly mistakes happen. And today, I'm sharing 10 powerful strategies that can help you make the most of your retirement savings. Let's jump in. First and foremost, we have to understand how 401k distributions are taxed. And before we dive into specific strategies, let's quickly understand the tax landscape we're working with. When you take money out of your 401k, these distributions are taxed as ordinary income. This means they're taxed at the same rate as your salary or wages would be. Your tax rate depends on your overall income for the year. These include earnings, retirement account withdrawals, pension payments, and other sources of income. The reason that this is important is because it's crucial to understand how and when you withdraw income from your 401k, because that can significantly impact your tax bill. Now let's take a look at our first strategy. Number one is taking advantage of NUA, or Net Unrealized Appreciation. This strategy is a bit of a hidden gem that many people don't actually know about. And if you hold company stock in your 401k, you might be able to benefit from something called Net Unrealized Appreciation, or again, NUA. Here's how it works. Instead of rolling your company stock into an IRA when you retire or leave the company, you can actually transfer it to a regular taxable brokerage account. When you do this, you'll only pay ordinary income tax on the original cost basis of the stock. That's what you paid for it initially and not the current market value. So the difference between what you've paid and what it's worth now is called the appreciation, and that's only taxed at lower long-term capital gains rates when you eventually sell the shares. For many people, this could be a difference of 7% by paying 15% instead of 22% tax. Imagine you have $100,000 of company stock in your 401k, but you only paid $20,000 for it over the years. With the NUA strategy, you'd only pay ordinary income tax on $20,000 when you transfer it to a brokerage account. Later, when you sell the stock, you'd pay the lower capital gains rate on $80,000 of appreciation, which is a substantial tax savings. The strategy isn't for everyone, but if you have highly appreciated company stock, it's definitely worth exploring with a financial advisor who understands the benefits of NUA. Strategy number two, leverage the still working exception. Did you know that you might be able to delay taking required minimum distributions from your employer's 401k if you're still working past age 73? This is known as the still working exception. Typically, the IRS requires you to start taking RMDs, or required minimum distributions, from your retirement accounts once you reach age 73 or 72 years old if you were born before 1951. However, if you're still employed and don't own more than 5% of the company, you can actually postpone taking RMDs from your current employer's 401k until you actually retire. Now, this exception doesn't apply to any other 401ks from previous employers or to IRAs, but it can be a valuable tax deferral opportunity if you plan to work well into your 70s. And of course, there is a caveat. This exception doesn't apply if you own more than 5% of the business's sponsoring plan. And that 5% includes ownership by your spouse, children, grandparents, and parents. So if you're a small business owner or have a substantial ownership in your company, the strategy won't likely work for you. Which brings us to strategy number three. This technique is called tax loss harvesting, and it can be particularly valuable in years when you're taking significant distributions from your 401k. For example, if you need to take a $20,000 distribution from your 401k, that would be taxed as ordinary income. You might be able to sell underperforming investments with a $10,000 loss in your brokerage account. That $10,000 loss could offset capital gains or reduce your ordinary income, potentially lowering your overall tax bill. Just be careful to avoid the wash sale rule, which prohibits claiming a loss if you buy the same or substantially identical investment within 30 days before or after the sale. Strategy number four, avoid the 20% mandatory withholding. When you take a distribution directly from your 401k, the plan administrator is required to withhold 20% for federal income taxes. Now, this is true even if your actual tax rate might be lower. For example, if you withdraw $50,000, you'll only receive $40,000 initially, with $10,000, which is 20% of $50,000, going to the IRS. If your actual tax rate turns out to be 15%, you'd get that extra 5% back, but only after you file your tax return. Here's a smart approach. Instead of taking a direct distribution, roll your 401k funds to an IRA first, then take your distribution from the IRA. IRAs don't have the 20% mandatory withholding requirement, so you can choose to have a more accurate amount withheld, or even no withholding if you prefer to pay your taxes when you file. This strategy gives you much more control over your cash flow and prevents the IRS from holding onto your money interest-free for months. Strategy number five, consider a 401k loan instead of a distribution. If you need access to your 401k funds but want to avoid taking a distribution, a 401k loan might be the best fit for you. The IRS generally permits you to take up to a 50% of your 401k balance as a loan, up to $50,000. These loans typically typically must be repaid within 5 years, and the interest you pay back goes into your account, so you're essentially paying interest to yourself. The beauty of a 401k loan is that it is not taxed as a distribution, and there's no early withdrawal penalty as long as you repay according to the loan terms. However, there is a significant risk to be aware of. If you leave your job or are terminated before repaying the loan, the outstanding balance typically becomes due within a short period of time, often 60 to 90 days following the termination of your employment. If you can't repay it by that deadline, the remaining balance is treated as a taxable distribution plus the 10% penalty if you're under 59 and a half years old. That could be a hefty tax bill and something that should be avoided at all costs. So while a 401k loan can be a useful strategy in certain situations, it's not without risks. Make sure you have a stable employment and a solid repayment plan before going this route. Strategy number 6 is watch your tax brackets carefully. One of the most powerful strategies for managing 401k distributions is to carefully monitor your tax brackets each and every year. Now, tax brackets are progressive, meaning different portions of your income are taxed at different rates. In 2024, for married couples filing jointly, the 12% tax bracket extends up to $94,300 in taxable income, with the 22% bracket starting after that. For 2025, these thresholds do increase slightly to $96,950 for couples married filing jointly. Here's the strategy. Limit your 401k withdrawals so you don't unnecessarily push yourself into a higher tax bracket. For example, if your other income already put you at $80,000 of taxable income for the year, you could withdraw up to $14,300 from your 401k while staying in the 12% tax bracket. If you need more money than that, consider withdrawing from Roth IRAs or taxable brokerage accounts. This approach is often called bracket management, which can significantly reduce your lifetime tax burden. Strategy number 7 is plan for capital gains tax advantages. This strategy involves coordinating your 401k distributions with your other investment activities to take advantage of preferential capital gains rates. Long-term capital gains from investments held longer than a year are taxed at 0% for taxpayers whose income falls below certain thresholds. In 2024, married couples filing jointly can pay 0% on long-term capital gains if their taxable income is below $89,250. This increases to $96,700 in 2025. Here's how to leverage this. If you take income from other sources like 401k distributions, this keeps you below these thresholds, where you could then sell appreciated investments and potentially pay no federal income tax. For example, if you need $100,000 for living expenses in a year, you might take $85,000 from your 401k and sell $15,000 of appreciated stock from your taxable account. If your total taxable income stays below the threshold, those capital gains could be tax-free at the federal level, which could mean huge savings for you. This strategy requires careful planning and coordination across all of your accounts, but the tax savings can be substantial, so it might be something to consider and consult with your advisor and your accountant about. Strategy number 8, roll over old 401k strategically. Here's a lesser known strategy that can help you delay RMDs. If you're still working past age 73, you can roll your old 401k and traditional IRAs into your current employer's 401k plan if the plan allows for it. Remember, the still working exception we discussed earlier only applies to your current employer's 401k plan. You'd still have to take RMDs from any other 401ks or traditional IRAs that you don't roll into your current plan. So by consolidating these accounts into your current employer's plan, you could potentially shield more of your retirement savings from RMDs until you actually retire. This strategy can be particularly valuable if you want to continue working and don't really need the income from your retirement accounts yet. This allows more of your money to stay invested and grow tax deferred for a much longer period of time. Strategy number 9, consider deferring Social Security. While not directly related to 401k distributions, coordinating your Social Security claiming strategy with your 401k withdrawals can significantly impact your overall tax situation. Social Security benefits themselves may become taxable if your overall income exceeds certain thresholds. For many retirees, large 401k withdrawals are what push them over these limits, making a portion of their Social Security benefits become taxable. By delaying Social Security benefits, which can increase your eventual benefit by about 8% for each year you delay up to age 70, you might be able to take larger 401k distributions in your earlier years during retirement, potentially emptying more of your 401k before Social Security kicks in. This approach can reduce your required minimum distributions later and potentially lower the taxation of your Social Security benefits in the long run, while increasing your month-to-month Social Security benefit because of its deferral. Which brings us to strategy number 10. Be aware of disaster relief opportunities. Our final strategy involves being aware of special tax relief that might be available during difficult times. The IRS occasionally grants relief for 401k distributions to people affected by natural disasters like hurricanes, floods, and wildfires. These provisions typically waive the 10% early withdrawal penalty and may even offer extended repayment options or other tax breaks to the borrower. Similar relief may be available for other hardships too, such as medical expenses, disability, certain educational expenses, or even first-time home purchases. While we hope you never need to access your retirement funds for emergencies, knowing these provisions exist can actually provide some peace of mind and potentially save you from paying penalties if you find yourself in a difficult situation. So following these 10 strategies, the idea is to create a personalized distribution strategy to help you minimize taxes and gain access to as much of your income as you need, as often as you need it. So from understanding these basic tax principles to exploring sophisticated strategies like NUA and tax bracket management, it's important to recognize that there is a a right way and a wrong way to do things, especially when it comes to tax planning during retirement. So when it's time for you to take a distribution from your 401k, or you're even considering retirement and want to be sure that you're paying as little tax in retirement as possible, click the link in the description below to schedule your first meeting today. Thanks for watching. Don't forget to like, comment, and subscribe, and we'll see you again soon.